So in the last class we have completed accounting in the books of transferee company. So we have completed the entire theory part relating to amalgamation, transferor books as well as transferee books. Now in the books of transferee, AS 14 is applicable and accounting treatment depends upon the type of amalgamation. If amalgamation is in the nature of merger, we need to follow pooling of interest method. If amalgamation is in the nature of purchase, we need to follow purchase method. And how we are going to pass the entries? So for acquisition of business, business purchase account debtor to liquidator of transfer or company account. For incorporation of assets and liabilities, in pooling of interest method, assets account debit at book value, to liabilities at book value, to reserves and surplus after adjusting losses if any, to business purchase. So in pooling of interest method, we will compare PC with what? Share capital. So if the PC is more than share capital, it is loss. That loss first adjusted against free reserves of transferor company. Secondly, free reserves of transferee. Lastly, debited to P&L account. But in case of purchase method, incorporation of assets account debit at agreed value, to liabilities at agreed value, to business purchase. Here purchase consideration is compared with net assets. If PC is greater than net assets, that is loss. That loss is treated as goodwill. But in both the cases, if purchase consideration is less than share capital or purchase consideration is less than net assets, it is profit, it will be transferred to capital reserve. And discharge of PC, liquidator of transfer or company account debtor to cash or bank, to equity share capital, to preference share capital, to debentures, to securities premium. And liquidation expenses, 3 cases. If liquidation expenses are borne by transferor company, in the books of transferee, no entry. If liquidation expenses are borne by transferee company itself, in pooling of interest method, general reserve or P&L account debtor to cash or bank. In case of purchase method, goodwill or capital reserve account debtor to cash or bank. Sometimes, as per the agreement between the companies, liquidation expenses are paid by transferor but reimbursed by transferee. In such a situation, when transferor company paid, in our books we will write general reserve or P&L account debtor to transferor. When we actually paid them, transferor to cash or bank. But in case of purchase method, goodwill or capital reserve account debtor to transferor, transferor to cash or bank. And most important entries are entry number 5, 6, 7, intercompany owings. So before amalgamation, if any sale and purchase transactions happened between the transferor and transferee companies, now at the time of amalgamation, in the books of transferee company, we need to eliminate any mutual owings between the parties. Generally the entry is creditors to debtors. And also one more thing is elimination of unrealized profit on goods unsold on the date of amalgamation. If any sale and purchase happened between transferor and transferee, if any stock is unsold at the time of amalgamation, in that stock if there is any unrealized profit is there, that profit also we will eliminate. And what is the entry? If pooling of interest method, general reserve or P&L to stock. If it is purchase method, goodwill or capital reserve to stock. Okay. And incorporation, last one, incorporation of statutory reserves, very very important, I told you. In case of pooling of interest method, no need to pass any separate entry because already all reserves are incorporated, including statutory reserves. But in purchase method, generally we don't take reserves of transferor company, but these statutory reserves we must maintain for some period of time as per the law. Therefore, statutory reserves will be credited, and to equivalent to amount a dummy reserve is created to nullify the effect of the statutory reserves, that is amalgamation adjustment reserve. So therefore the entry is amalgamation adjustment reserve account debtor to statutory reserve. So this is what we have discussed, and I told you transferor books there are 13 entries, transferee books pooling of interest method 6, purchase method 7. So total 26 entries will come in amalgamation chapter. So you have to revise these entries number of times so that when you are solving the problems it becomes very easy for you. Already in this chapter we have solved first 5 questions. First 5 or 6? 5. Now let us solve the remaining questions. Okay. Today is about solving the questions. We already solved question number 5 in the last class. Transfer our books. Now, question number 9, sir, illustration 9. One of the very, very important illustrations. Very good sum actually this is. Illustration 9 we are going to solve. Everybody please open illustration 9. Illustration 9. Okay, wow. Illustration 9 Nana. Now see the question carefully. I am reading. Everybody please concentrate on the question. No in between talking please. Don't disturb the flow. The following are the balance sheets of P Limited and Q Limited as at 31st March 2011. Equity and liabilities, shareholders funds, share capital note 1, 8 lakhs, 4 lakhs, reserves and surplus 3 lakhs, 2 lakhs. Non-current liabilities, we have long-term borrowings note 2, 2 lakhs, 1 lakh 50. Current liabilities, we have trade payables 2.5, 1.5. Coming to assets, non-current assets, property, plant, equipment 7 lakhs, 2.5 lakhs. Non-current investments 80,000, 80,000. Current assets, inventories, trade receivables, cash and cash equivalents. Notes to accounts, if you see, share capital, equity shares of 10 each, 6 lakhs, 3 lakhs. 10% preference shares of 100 each, 2 lakhs, 1 lakh. In long term borrowings, we have 12% debentures, 2 lakhs, 1.5 lakhs. Now details of trade receivables and trade payables are as under. In trade receivables, if you see, we have debtors as well as bills receivable. In trade payables, we have sundry creditors and bills payable. So trade receivables, debtors, bills receivable, trade payables, sundry creditors, bills payable. Now, so these are the details given in respect of P Limited and Q Limited. Now what happened? See this. Property, plant, equipment of both the companies. Both. Here the important word is both. Property, plant, equipment of both the companies are valued, revalued at 15% above book value. Therefore, P Limited, Q Limited, property, plant, equipment, we need to increase 15% because they have done the revaluation. Next, again both the companies are to pay 10% equity dividend. So, what are the common things need to be done in P and Q? Revaluation of PPE by 15%. Both the companies are need to pay 10% equity dividend. But preference dividend having been already paid. So preference dividend already paid. Now these are the things, common things. Next what happens, see here. After the above transactions are given effect to, after the above transactions are given effect to, P Limited will absorb Q Limited. See here. P will absorb Q. So P limited will take over Q limited. So here P limited is transferee, Q limited transferor. Now important word here is after the above transactions are given effect to. That means first we need to adjust the above things in their books, after the takeover happen. So P limited will absorb Q limited on the following terms. So see this first point. 8 equity shares of 10 each will be issued by P limited at par against 6 shares of Q limited. So every 6 shares, sir, 8 equity shares will be given by P limited. That is nothing but PC, purchase consideration. So if you see Q limited share capital, Q limited equity share capital is 3 lakhs. Each share face value 10 rupees. So 3 lakhs divided by 10, 30,000. Correct? So 30,000 shares. 30,000 for every 6, 8 shares. So 30,000 divided by 6 into 8. 40,000 shares will be given. Each share 10 rupees. So 4 lakhs is the purchase consideration in the form of equity shares to the equity shareholders of Q limited. So very simple, sir. For every 6 shares, 8 shares is given of rupees 10 each, issued at par only. So therefore in Q limited 30,000 shares are there, divided by 6 into 8. So 40,000 shares will be given, each share at 10 rupees. So 40,000 into 10, 4 lakhs. So one part of PC we got it. Next, 10% preference shareholders of Q limited will be paid at a 10% discount by issue of 10% preference shares of 100 each at par in P limited. Look at the wordings. Now they are talking about preference shareholders purchase consideration payment. 10% preference shareholders of Q limited will be paid at a 10% discount. Actually in Q limited the preference share capital is 1 lakh. See here 1 lakh. This is paid at a 10% discount. That means 1 lakh into 90%, 10% discount. Therefore 90,000 is the PC. 90,000 is the PC. This 90,000 is paid by issue of 10% preference shares of 100 each at par. That means 90,000 divided by 100. 900 10% preference shares of 100 each at par will be given. Sir, here we are not issuing preference shares at a discount. We are paying them at a discount of 10%. Therefore, the preference share capital of Q limited is 1 lakh minus 10%, 90,000 is the PC. This 90,000 we are going to pay by way of 10% preference shares of 100 each at par. Therefore, can you say total purchase consideration? 4 lakhs 90,000. So 4.9 lakhs. So purchase consideration in this problem is 4 lakh 90,000. Because PC means what? Only the amount paid to shareholders. Okay. Next up. Point number 3. This is the most important point in this sum. Point number 3. Everybody please observe. 12% debenture holders of Q limited are to be paid at 8% premium. So debentures in Q limited, sir, 12% debentures is nothing but the liability of Q limited. That liability is paid by P limited, transferee company, at 8% premium. How? By 12% debentures in P limited. Therefore, to the debenture holders of Q limited, P limited will issue its own debentures, issued at a discount of 10%. But those debentures are issued at a discount of 10%. First of all, tell me in Q limited what is the total debentures amount? 1,50,000. See here 1,50,000. In Q limited 1,50,000 is the debentures, right? And we are paying at a premium of 8%. So can you tell me 1,50,000 plus 8%? 1,62,000. But this 1,62,000 is paid by issue of 12% debentures in P limited, which are issued at a discount of 10%. That means this 1,62,000 is after discount. For example, 100 rupees is the value. In the 10 rupees discount we have given, that means 90. So this 1,62,000 is equal to 90 after discount. Suppose if I convert this to 100, 1,62,000 into 100 divided by 90, 1,80,000. So 1,80,000 face value of debentures issued at a 10% discount. 1,80,000 minus 10% discount, it will be 1,62,000. Very, very important adjustment. So first of all, P Limited taken the debentures of Q Limited and paying at 8% premium. So 1,50,000 plus 8%, 1,62,000. But this 1,62,000 is paid by issue of its own debentures, and those debentures are issued at a discount of 10%. So therefore 1,62,000 is after discount. So if I convert them into the face value, what is the face value of debentures I am issuing? 1,62,000 into 100 divided by 90, that is 1,80,000. So if you want, you can check it. 1,80,000 face value of debentures minus 10%, it is equal to 1,62,000. That is exactly the value of amount what we are need to pay to the debenture holders. So this is the important point here. Next, fourth point. Rupees 30,000 is to be paid by P Limited to Q Limited for liquidation expenses. So who is paying the liquidation expenses? P Limited to Q Limited. That means this is which case? Third case. Actually first liquidation expenses are paid by transferor, later on reimbursed by transferee, because here 30,000 is paid by P Limited. P Limited is transferee. So transferee company is making payment to transferor company for liquidation expenses. That means first transferor company will incur the expenses, later on transferee company will make the payment. So therefore what is the entry here? When they incurred, suppose this question, in this question, is it amalgamation in the nature of merger or purchaser, we need to see, because here they are asking entries in the books of P Limited. Who is P Limited? Transferee. I told you in the books of transferee the accounting treatment depends upon type of amalgamation. What is the type of amalgamation here? That fifth point is telling you the type of amalgamation. Because you read the fifth point, inventory, trade and debtors are taken over at 5% less than their book value. This is definitely amalgamation in the nature of, because in case of merger all assets and liabilities are taken at book value. But here clearly saying inventory and debtors are taken 5% less than their book value, which indicates that this is amalgamation in the nature of purchase. Now if it is amalgamation in the nature of purchase, which method we need to follow? Purchase method in the books of transferee. Next. In fourth point, one more thing, sir. Sundry creditors of Q Limited includes 10,000 due to P Limited. That means in Q Limited, sundry creditors is P Limited. In P Limited, sundry debtors is Q Limited. Both will be eliminated. Intercompany owings. Sir, this point intercompany owings, sir. Mutual owings. Because you see, sundry creditors of Q Limited includes 10,000 due to P Limited. So therefore, this question is very, very important. Why this question is important now? Because they are asking transferee company books and also purchase consideration. Before amalgamation, some things happened. What are the things happened before amalgamation? Revaluation of assets to equity dividend. After given effect of these transactions, P has taken over Q Limited. So therefore, you need to write the entries in the books of P Limited, transferee company. Now tell me, amalgamation in the nature of purchase, transferee books, what entries will come? How many entries will come? 6, depending upon the situation. Okay, so first entry, business purchase. Second entry, incorporation of assets and liabilities. Third, discharge of PC. Fourth, liquidation expenses. Fifth, intercompany owings. Sixth, any elimination of unrealized profit is there? No. And last one, incorporation of statutory reserve will not come. But here extra entry is debentures entry, and 2 more entries will also come. Okay, so we are going to solve this sum, sir. So very, very important sum. Please start. So this is illustration 9th sum. So EBIT they are asking. In the books of P Limited, transferee company, journal entries. Okay. Okay. Now, sir, in this case, will you write, will you start writing directly amalgamation entries? No. Before amalgamation, both the companies has done certain things. We are writing entries in the books of P Limited. So P Limited also has need to done two things. One is revaluation of assets. Second one is equity dividend. So first you need to write those entries. So first entry, revaluation of assets. Sir, assets have been revalued by 15% above book value. That means assets have been increased. So when the asset value increased, what is the entry? PPE, account debit to revaluation reserve. Asset or PP in this case exactly, revaluation reserve account. 15% above the book value. Actually PPE in P Limited you have to see. 7 lakhs. We are writing entries in the books of P Limited. 7 lakhs. 7 lakhs into 15%. 1 lakh 5,000. Important. 1 lakh 5,000. Sir, we are writing entries in the books of P Limited and we are revaluing the assets of P Limited. Being PPE revalued 15% above book value. Okay. Next. And also both the companies has done one thing, sir. What is that? Dividend. Which dividend? Equity dividend. Equity dividend. So what is the equity share capital of P Limited? 6 lakhs into 10%. That means how much? 60,000 dividend. So whenever we declare a dividend, dividend is declared from reserves and surplus. So therefore the entry is reserves and surplus account debtor to equity dividend. Equity dividend account debtor to cash or bank. Because generally dividend is given from reserves. So therefore the entry is reserves and surplus account debit to equity dividend account. Sir, P Limited, sir, being equity dividend declared, it is declared from reserves and surplus. So how much? 60,000, sir. 6 lakhs into 10%. Next you pay the dividend, sir. Equity dividend account debit to cash or bank account, right? So to bank I am writing 60 being equity dividend paid. So you have paid the dividend. Now after the given transactions are affected to, now amalgamation happened. Now P Limited has taken Q Limited. Now you need to write what? Amalgamation entries. Which method? Purchase method. So here onwards you need to write first. What is the first entry? Business purchase to liquidator of Q Limited. So business purchase, I want every one of you to practice here. Practice makes you perfect. So don't waste your time. At least in the classroom, be 100%. Liquidator of Q Limited. So business purchase to liquidator of Q Limited. Already we calculated PC, sir. How much, sir? 4 lakhs 90,000. Of course, Second, we will do purchase consideration calculation separately. They have asked, being P Limited acquired Q Limited. So acquisition happened. This is the entry. Fifth entry, incorporation entry. I think this entry is the most important entry. See how many of you will tell correctly. Sir, this is purchase method. So therefore assets account will be debited. At what value? Agreed value. If no agreed value, book value. Two liabilities. At what value? Agreed value. Will you take reserves and surplus? No. To business purchase. The difference. That means purchase consideration is compared with net assets. If PC is more than net assets, goodwill. If PC is less than net assets, capital reserve. So therefore assets. First we need to write one by one asset of Q Limited. Come to assets of Q Limited. First PP, property, plant, equipment. How much is there? 2 lakh. Tell me how much we will write. PP account debit 2 lakh 50,000. Wrong. Because in the question clearly said both the companies have done what? Revaluation. After revaluation happened, P is taking Q. That means in Q Limited also revaluation must happen. So this figure 2,50,000 is before revaluation. 2,50,000. So therefore 2,50,000 into 115. Correct? 15% I need to increase. 2,87,500. This is important. Understand. That's why I said this is important. See, I am writing incorporation entry as a P Limited. From Q Limited I am getting what? PP. Now I am writing PP as my own asset. At what value? 2,50,000 plus 15% also happened in Q Limited, na? That's why. Next, what is the next asset? Non-current investment. So investments. Investments at what value? Book value, no adjustments. 80,000. Next, current assets, inventories. Important. Tell me, inventories are taken at what value? Book value or agreed value? Agreed value. In the question clearly said inventories in trade is taken less than 5% of book value. Correct? What is inventories value actually? 3,20,000 into 95% only we need to take. 3 lakhs? Important. 3,04,000 because agreed value given in the question. So P has taken Q Limited inventories 5% less than their book value. Therefore 95%. Next, trade receivables. Trade receivables. Trade receivables account debit. Book value or agreed value? Agreed value. Inventories as well as trade receivables. Both are taken 5% below the book value. Please read the question. Oh, only debtors. Very good. Correct. See, because in the question we have a breakup. Trade receivables includes debtors as well as bills receivable. Okay. So we also need to write separately for this. Here don't write trade receivables because trade receivables includes two things. What are those? Debtors as well as bills. Now important. First you take debtors. Sir, debtors are taken 5% below the book value. What I will do is that 5% I will create provision and I will write credit side separately. Here I will write total value. What is the total debtors value? 1,90,000. 1,90,000. See here, breakup given. 1,90,000. So I will write here 1,90,000. Credit side that 5% I will create a provision. Generally that is the practice. Because your debtors I am taking, sir, I am taking less than book value. That means that is provision I am considering. I am considering that is as provision. Therefore, debtors 1,90,000, credit side 2 provision for doubtful debts I will write. 5% on 1.9 lakhs. Everybody. Next to bills receivable. Bills receivable separately you need to write. How much? 20,000. Next. Next, any other asset? Cash and cash equivalents. Cash. Cash, very, very important, sir. Tell me, sir. In Q Limited, how much cash is there? 40. Will you take 40? No, because you have paid equity dividend. Both the companies have to pay equity dividend. So if Q Limited also paid equity dividend, what will be the cash balance? 40,000 is the cash balance. In Q Limited, what is the equity share capital? 3 lakhs. On 3 lakhs, if they paid 10% dividend, it will be 30,000. Therefore, 30,000 they will go. There is an outflow in the form of dividend. Everybody, sir, both the companies paid dividend, sir. That means Q Limited will also pay dividend, na? Therefore, if Q Limited pays the dividend on 3 lakhs, 10%, 30,000 will go out. Therefore, only 10,000 is the cash balance which remains in Q Limited. That will be taken by P Limited. Everybody got it, ah? That's it. I think these are the assets. Okay? Here you add this as cash at bank because we have written above bank. I think these are the total debit side. Leave one line and write credit items. First I am writing provision for bad debts or doubtful debts, whatever. How much provision you create, tell me? 5%. So 1,90,000 into 5%. So P has taken Q Limited debtors 5% less than the book value. So 1,90,000 into 5%, how much ma? 9,500 I need to take. Next. Next, sir, what are the liabilities? Non-current liabilities, long-term borrowings is there. How much? 1,50,000. Now important. 12% debentures. Sir, this 12% debentures of Q Limited, we are ready to pay at a premium of 8%. So therefore, actually, what is the total debentures? 1,50,000 plus 8% premium. How much, sir? 62,000. Correct? Important, agreed value. Debentures of Q Limited are taken over at 8% premium. We are ready to pay 8% premium. So therefore 1,50,000 plus 8%. Okay? 1,62,000. Next. Next, trade payables 1,50,000, but breakup given. Sundry creditors, 2 sundry creditors. How much sundry creditors? 1,25,000. 2 bills payable. How much? 25,000. So I think I have written all assets as well as liabilities. Now to business purchase. What is the PC we are paying? 4,90,000. 4,90,000 is the PC what we are paying. Now first calculate the net assets. Assets minus liabilities. How much came? Tell me. Assets minus liabilities. Total debit side assets minus liabilities. Total assets minus liabilities. 5,70,000. Correct? 5,70,000. Assets minus liabilities. So total net assets you are taking 5,70,000. But how much PC we are paying? 4,90,000. So PC paid is less than net assets. So profit or loss? We are taking business worth of 5,70,000, but we are paying only 4.9 lakhs. That means we are at the profit side. The profit will be transferred to capital reserve. So credit side you write to capital reserve. Capital reserve 80,000. Balancing figure. Balancing figure. Important entry. Please concentrate. Please learn it properly. Being incorporation of assets and liabilities of Q Limited. So incorporation of assets and liabilities done. But here you need to understand which are all the assets and liabilities we have taken at agreed values. Inventory, agreed value. Debtors, agreed value. But debtors present gross value on the debit side, provision you write separately. And then debentures are taken at agreed value. Okay. So these are the assets and liabilities we have taken at agreed value. Even if you do one thing wrongly, your capital reserve balance will go wrong. So therefore you have to be absolutely perfect, and that perfection comes only through practice. Only when you practice, then you will understand what are the intricacies in that particular question. Okay, everybody respond. Have you understood? See, this provision for bad, see, for example, I am P, you are Q. In your company, there is a debtors of 1,90,000, but I am ready to take it 5% below. Why? Because from my point of view, I have a doubt regarding collection. Or I will ask your management that out of total debtors, what, or maybe it is like this. P Limited practice is to create 5% provision on their debtors. So therefore, from Q Limited, whatever the debtors is coming, I am casually creating a provision. Because in case of debtors, there is no such thing as directly reducing the asset from the asset value. So we will only create what? Provision. That's why debtors we will write gross value and provision we create separately. That is what we have done. Okay. Next. So incorporation entry done, sir. What is the next entry, sir? Hello. Tell me. First business purchase over, next incorporation over. What is the next entry? Discharge of PC. So what is the entry? Liquidator of Q Limited. Liquidator of Q Limited account debit to what we are giving in the form of PC. Equity shareholders, we are giving equity shares to equity share capital account. And to important, sir, here I have written how many equity shares we are giving, sir? 40,000. Each share we are giving at par 10 rupees only. So therefore 40,000 into 10. How much? 4 lakhs. Any securities premium? No. To preference shareholders we are giving what? 10% preference shares. 10% preference share capital account. How many preference shares we are giving, sir? 900. Each one at 100. So therefore 90,000. So total it will be 4,90,000. Securities premium will not come here because we are issuing equity shares at par. Preference shares also at par only. So therefore when you issue shares at par, premium will not be created. So that is the logic here. So liquidator of Q Limited account debit to equity share capital to 10% preference share capital. So being PC discharged. So PC was discharged. Next up. Now sir, liquidation expenses. Before going to liquidation expenses, first I am going to discharge debenture holders. Very important, please observe. Sir, first of all, from Q Limited, we have taken our debentures now. See here, in incorporation entry we have written 2 debentures, 12% debentures. How much? 1,62,000. Now this 12% debentures of Q Limited, 12% debentures first we have taken in our books. Now in place of, these are Q Limited debentures and we have taken at 1,62,000. And in place of this 12% debentures, we are giving our, see here, own debentures. P Limited is issuing 12% debentures to 12% debentures. We are writing entries in the books of P Limited, sir. Sir, please understand. We are P Limited. We are issuing debentures. When we issue debentures, debentures will become our liability. Whatever the liability we have taken from Q Limited, we incorporated. Later on we are cancelling. In place of that, we are issuing our debentures. But here they are telling that these debentures are issued at a discount of 10%. So 1,62,000 into 100 divided by 90. 1,80,000 face value of debentures we have issued. That means 18,000 will become what? Discount on issue of debentures. Discount on issue of debentures. discount on issue of debentures account debit. This is the balancing figure. So debentures are taken at 8% premium, discharged by 12% debentures of P Limited, issued at a discount of 10%. That means after 10% discount, the value should be 1,62,000. So therefore 1,62,000 is equal to 90. How much is for 100? 1,80,000. So therefore if I issue 1,80,000 face value of debentures at a 10% discount, it is exactly equal to 1,62,000. Hello, got it? This is one of the very important point. Later on you are going to confuse. Understand, we are P Limited, we have taken Q Limited. So from Q Limited, first of all, debentures are taken. Debentures value 1,50,000. We are paying 8% premium. 1,50,000 plus 8% premium, 1,62,000. See this, incorporation entry, we have taken at 1,62,000. Now this 1,62,000 we are discharging by issuing our own debentures. Therefore, the debentures which we have taken as a liability will be cancelled. In that place, our own debentures, our liability will arise. P Limited liability. So, debentures account debit to 12% debentures. These are P Limited debentures. And we are issuing at 10% discount. Therefore, 1,62,000 into 100 divided by 90, 1,80,000 face value of debentures we are issuing. So, being 12% debentures were issued to debenture holders of Q Limited. So P Limited has issued 12% debentures to Q Limited debenture holders. How many of you understood this entry? Please raise your hand. Okay. Next, liquidation expenses entry, sir. Sir, in this case, liquidation expenses, how much paid by P to Q? 30,000. That means, can I assume like this? First Q Limited will pay, then later on P Limited will reimburse. So therefore here two entries are possible. First, when Q Limited paid, what entry P Limited will write? This is amalgamation in the nature of purchase. This is third case. Sir, actually incurred by Q, paid by P. First incurred by Q. So when they incurred, what entry we will write? No entry when transfer directly incurs. But we said first you incur, later on we will reimburse. In that case, entry will come. When transferor incurs the expenses, what entry will write in purchase method? Goodwill or capital reserve account debtor to transferor. Correct? Here goodwill or capital reserve? Capital reserve. Capital reserve. So therefore I am writing here first capital reserve account debit. Capital reserve account debit to Q Limited. How much? 30. Being liquidation expenses incurred by Q Limited. When they incurred, what entry we will write? Next, pay. When you make the payment, Q Limited account debit to bank account. 30. That means ultimately what is the entry we have written? Capital reserve to cash or bank. Capital reserve to bank. Being liquidation expenses paid to Q Limited. So we have paid liquidation expenses to Q Limited. Sir, in the study material, they have written like this. What they have written is, see here, goodwill account debit. They have debit to goodwill. Later on, this goodwill they adjusted with capital reserve. Anyway, both are same only. Ultimately, capital reserve will survive. Goodwill will be cancelled. So therefore, this is the correct entry. You follow this. Capital reserve to Q Limited to bank. So ultimately, the entry is capital reserve account debtor to bank. Next, sir, intercompany owings. Important. Sir, here, if you read the question carefully, fourth point you see, sundry creditors of Q Limited include 10,000 due to P Limited. Actually, see, in incorporation entry, we have taken sundry creditors of Q Limited. See this one. Hello. Sundry creditors of Q Limited, we already incorporated in our books. In this 1,25,000, amount due to P Limited is also there, na? Therefore, we need to cancel sundry creditors. Sundry creditors which we have incorporated in incorporation entry of Q Limited to sundry debtors of our company. Both will be cancelled. Mutual owings 10,000, 10,000. So Q Limited books sundry creditors include P Limited. That means P Limited books sundry debtors includes Q Limited, na? So both have to be eliminated. Because now they are becoming one entity. Q is merging with P. Therefore, receiver and payer should not be the same person. That's why mutual owing should be eliminated. So important, being mutual owings eliminated or cancelled. Mutual owings cancelled. So that's it, mutual owings cancelled. Next, any unrealized profit? No. So any statutory reserves? Incorporation? No, because this is amalgamation in the nature of purchase. Statutory reserves, if their existence, it will come. But no statutory reserves in the company. Q Limited books, there are no statutory reserves. So therefore, that's it. These are the entries. And they are asking what? PC, purchase consideration. Purchase consideration. Particulars, amount. Particulars, amount. First two, equity shareholders. Sir, equity shareholders, how PC are giving, sir? 8 equity shares against 6 shares, right? 8 equity shares of rupees 10 each issued at par against 6 equity shares of Q Limited. So therefore, tell me how we are going to calculate. In Q Limited total how many shares? 30,000 divided by 6 into 8. That means how many shares? 40,000 into 10. So total 4 lakhs is the PC. 2 equity shareholders. Now coming to preference shareholders. 2 preference shareholders, 10% preference shareholders of Q Limited will be paid at a 10% discount. 10% preference share capital of Q Limited paid at 10% discount, right? That means what is the total capital? 1 lakh into 90%. How much? 90,000. So total it will be 4 lakhs 90,000. So this is question number 9. Now in this question lot of important points is there. Definitely one of the practicable sums, you do practice it, mark it as important question, and the important points are incorporation entry. So lot of important points are there. These changes before amalgamation entries. Incorporation entry is the most important entry. Please everybody carefully observe. And then debentures adjustment entry, debenture settlement entry is another important entry. Liquidation expenses. That's it. So I think the chances that you may go wrong is incorporation entry, debentures entry, liquidation expenses entry. I think remaining and all you can easily manage. Respond. Have you all understood? Any doubts to anybody? You can ask. I will clarify. So shall we proceed to the next question? Okay. So this is question number 9 now. So illustration 9 done. Now next I am going to do one small question. We have done one big question, right? Come to question number 23. Case scenario based questions. Study material questions, these are all. 23. Page number 219, I think. 219. One small question is there. See there, PC calculation. So PC calculation can be asked as a separate question, sir, or maybe can be asked as MCQ also. See this question 23. Don't look at the answer, see the question. I am reading. Everybody. X and Company Limited having share capital of 50 lakhs divided into equity shares of 10 each was taken over by Y Company Limited. So X Company Limited is taken by which company? Y. So who is transferee? Y. Who is transferor? X. Okay. Y Company Limited issued 11 equity shares of rupees 10 each for every 10 shares of X Company Limited. Sir, for every 10 shares of X Company, Y Company will issue 11 equity shares. First of all, tell me, sir, in X Company Limited, that is transferor company, how many equity shares are there? 5 lakhs. Very good. 50 lakhs divided by 10, 5 lakh shares. So 5 lakhs divided by 10 into 11. How many shares? 5 lakh 50,000 shares are given. Each share is given at 10 rupees. So therefore, what is the total consideration? 55 lakhs. This is PC. Y and Co is issuing to X and Co. So for every 10 shares, 11 shares are given. In X and Co, we have 5 lakh shares. So 5 lakhs divided by 10 into 11. So total 5 lakh 50,000 shares of rupees 10 each. So 55 lakhs. Now see what they are asking. Explain how the difference will be adjusted in the books of Y and Co for the shares issued under the pooling of interest method for amalgamation. Sir, I told you this is the right time to apply the concept. Tell me, pooling of interest method, transferee company, paying purchase consideration. How much purchase consideration? Y and Co is paying how much purchase consideration? 55 lakhs. We will compare purchase consideration under pooling of interest method with what? Share capital. What is the share capital? 50 lakhs. So how much excess we are paying? 5 lakhs. This 5 lakhs is adjusted against free reserves of transferor. So that is the treatment. Therefore here this excess of 5 lakhs will be adjusted through general reserve. That means free reserves. You write down here free reserves. So these are the small questions they may ask. Sir, yesterday we have spent enough time, sir, in pooling of interest method. I told you the logic also. In pooling of interest method, why we will compare purchase consideration with share capital of transferor company? Because exactly that much worth of business we are taking. We are taking assets, we are taking liabilities, we are taking reserves. Therefore, assets minus liabilities minus reserves, one amount will come. That amount is obviously equal to share capital only. Because in the balance sheet, you are taking assets, liabilities, reserves. So what will left out? Share capital. Therefore, purchase consideration is compared with share capital. Here purchase consideration is 55 lakhs. Share capital is 50 lakhs. Therefore, 5 lakhs is the excess amount you are paying. This excess amount is nothing but loss. This loss will be adjusted against free reserves of transferor company. Suppose if transferor company reserves not sufficient, transferee company. If transferee company free reserves also not sufficient, debited to P&L account of transferee company. This is 23, sir. Mark it, completed. Next, come to 24. This is also question relating to PC, purchase consideration question. So see here, what they are asking, calculate the amount of PC as per AS 14. Okay. On 1st April 2018, Tina take over the business of Reena Limited. So which company is transferor? Transferee who? Tina. Who is transferor? Reena. So Tina took over the business of Reena and discharged purchase consideration as follows. How purchase consideration is paid? Issued 50,000 fully paid equity shares of 10 each at a premium of 5 per share to the equity shareholders of Reena Limited. So to the equity shareholders of Reena Limited, sir, 50,000 fully paid equity shares are given. Each share is given at premium of 5. Therefore 50,000 into 15. 7,50,000. This is the PC. Important, sir. 50,000 shares are given, each share 10 rupees, but given at a premium of 5. 7,50,000. 50,000 into 15. Next, cash payment of 50,000 was made to equity shareholders. So this is also part of PC. Next, issued 2,000 fully paid 12% preference shares of 100 each at par to discharge the preference shareholders of Reena Limited. So therefore 2,000 into 100, 2 lakhs. This is paid to whom? Preference shareholders. Reena. Next, fourth point talking about debentures. Debentures of Reena Limited, 20,000 will be converted into equal number and amount of 10% debentures of Tina. Will it consider as a part of PC? No, because only amount paid to shareholders is considered as a part of PC. So therefore, first point, second, third, these three talks about amount paid to the shareholders. So therefore, add everything, 7,50,000 plus 50, 10 lakhs is the PC. See here, 10 lakhs is the purchase consideration. Equity shares 50,000 into 15, 7,50,000. Cash payment 50,000. 12% preference share capital 2 lakhs. So total PC 10 lakhs. And payments to debenture holders are not covered in PC. And they are asking also one more thing, sir. Past journal entry relating to discharge of PC in the books of Tina Limited. So Tina Limited is which company here? Transferee. So in the books of transferee, what is the entry for discharge of PC? Tell me. Liquidator of Reena Limited account debtor 2 equity shares 50,000 into 10. 50,000 into 5 will go to securities premium. Because here we are issuing equity shares at a premium of 5. So therefore, the entry here is, see here, liquidate, not liquidation, liquidator. Liquidator of Reena Limited, 10 lakhs is the PC. 2 equity share capital. How many equity shares? 50,000 into 10 only. Face value will be transferred to equity share capital. And securities premium 50,000 into 5. So 2,50,000, this is premium. And we have given cash also. How much? 50,000. And to preference shareholders we have given what? See here, 12% preference shares. Each is given at par only. So therefore 2,000 into 100. 2 lakhs. So I told you while explaining theory also, when you are writing discharge entry in the books of transferee, there is a chance that securities premium may come. Because you may issue shares, debentures above the face value. In this case, shares are issued above the face value. Everybody got it? That's it. This is question number 24. So we completed 24. And also we have one more questions relating to PC, sir. Come to illustration 12. Come to illustration number 12. Page number 191. Illustration 12. Look at this question. Here also, what is the requirement? Amount of PC. See the question. A Limited take over B Limited on April 1st, 2011. So A Limited is which company? Transferee. B Limited? Transferor. And discharge consideration for the business as follows. Issued 42,000 fully paid equity shares of 10 each at par to the equity shareholders of B Limited. So can you tell me PC? 4,20,000. So 42,000 into 10. Correct? Here issued at par only. Next. Issued fully paid up 15% preference shares of 100 each to discharge the preference shareholders rupees 1,70,000 of B Limited at a premium of 10%. So important, sir. Sir, we are issuing 15% preference shares of 100 each to discharge the preference shareholders of B Limited at a premium of 10%. Therefore, 1,70,000 plus 10% premium. How much? 1,87,000. And third point, it is agreed that debentures of B Limited will be converted into equal number and amount of 13% debentures. So here this point is talking about payment to debenture holders. Will it part of PC? Only amount paid to shareholders is part of PC. So therefore add these two things. 4,20,000 plus 1,87,000. 6,07,000. This is PC. 6,07,000. Say this. Equity shareholders directly 4,20,000. Preference shareholders, preference share capital plus premium also we need to add. And as per accounting standard 14, we should not include. So payment made to debenture holders as a part of PC. That's it. This is question number illustration 12, sir. So we completed illustration 12. Okay. So